Hello guys, glad to have you on board again today. I hope you enjoyed your New Year's Eve, or if you didn't really give a shit about, then that's no big deal. Let's do this little retrospective of 2019 and just try to project out of the scenarios I'll be trying to forecast for 2020. Remember that anyway, we're not trying to do like weather forecast or whatever that could be. We're just risk managing in here. And let's go straight into this center of the maze. 2019 was pretty much hell of a year for risk manager and risk management in general. Especially into those time frames, which is weekly to monthly or eventually even quarterly time frames that we're going to talk about today. So if we focus on those time scales, there has been a lot of pain over 2019, which means, and I really stand on this, the key elements I'm going to say all over again into this podcast today is that risk managing in any way, so many people want to make that shortcut that as we can put markets into little boxes that can sometime explain, and once again, explaining is not even the right word to use in this. It's more like, statistically speaking, we can take out positive rewards. And it's not because we understand markets. It's just, I can't stress that enough. It's like for you guys to get into a different country. Like, imagine me as a French people reaching out to England without talking English. That doesn't mean I can't go there. That just means I'm not going to understand shit. And the thing is that talking English doesn't nearly make me understanding English people. All right? So it's not really about understanding. It's more about being able to communicate. So learning the language, learning English when you go to England will allow you to interact with English people. You're never going to understand this culture anyway. You're not coming from this. So it's pretty much like the same when it comes to market. You're never going to understand anything about markets. All you can do is that when you learn risk management, at least you learn the language, which allows you to communicate with market without being slapped too hard in the face like many people tend to do. So as long as you understand that 2019 has been hell of a slap in my face anyway. And yes, I'm certainly not going to hide from it. I'm certainly not going to run away. It's just it's the hard way sometimes you get to learn the same old lesson when you get to deal with market behaviors anyway, is that there is this ugly way of thinking that anyway, as you put things into little boxes and as you tend to communicate with markets, you're going to feel like you understand or you control anything. I so many times tell you that you never will. And I know that. I definitely know that. I've been learning that lesson the hard way years ago. The thing is that it's somehow happened again. Now that I have been taking a little bit of distance with the market recently, over the latest few weeks, it allowed me to see a lot more clearly what were the problems and work them out. So, as an introduction, we'll state this. Like, I think talking about the problem is absolutely necessary anyway. So yes, 2019 has been a problematic year for me. I made absolutely no gain, so I barely terminated the year flat. So thankfully, over the latest years, the latest hours actually, the market managed to bring me a little bit of gains. But it certainly isn't enough regarding the crazy amount of work and time spent into trading this year. So in terms of financial profitability for the year, I'm definitely not into where I would have expected to do. But that doesn't mean this time was a waste in any way. It's just that, yeah, no financial reward, and that can be painful, obviously. But I mean, no problem. I wasn't down the corner, so I can definitely handle this anyway. But I've been taking a really, really hard lesson. But at some point, if I were just trying to see the broader picture, that's basically, and I'm gonna just take a minute for this. Some people might have been thinking at a given time that I was going somehow crazy, like I mean, he's been taking too much losses or whatever. It's just gone crazy. This is why he stopped the services of pro indicators and stuff like that. I mean, he's just going mad. That's absolutely not this. It's just a protection mechanism. I mean, definitely something was going way too painful at the end of this year, psychologically speaking. A lot of pressure to handle, and not just mine. I mean, now that this all services have gone way further than we would never ever imagine this years ago, and at some point, I have responsibilities, and the problem is those responsibilities have been multiplying the psychological impact of this year, that this year had on me. Because it wasn't just about me, it was also about what I was teaching to you, and rationally speaking, that on a day-to-day basis, it wasn't even working. And that's the problem, all right? Like, I'm trying to teach you something, but when it's objectively speaking not working right in front of my eyes, it's really complex to just say something and just say, all right, just blindly follow me, and I just couldn't be doing this again at the end of this year. So I'm going to cut the crap and go straight to the essential. That doesn't mean that my thing isn't working. It certainly isn't about that. It's just that in any way, what I'm trying to teach you is this language, this thing that will help you putting the market context into boxes, not boxes that predict the future, but just boxes that gets you more profitable trades when you always follow the same path. The thing is that you must not go emotional with a single trade. So the thing in here is that the only variable in here that wasn't nearly even close to imagining when I got myself into these long-term scenarios, that personally for me, it's the first time I'm dealing with end of economic cycles. And let's be honest, it's still possible end of economic cycle at the current given time. So there is still room for failure. And just as years ago, I've been learning that any fucking way, failure is always an option when you get to trading. And it's not about fearing failure or seeking truth that you're ever gonna get to be profitable in trading. You're more about using your same old rules and repeating them, and not caring about unique scenarios. That the only thing that matters actually is when you replicate this thing with always the same experimental rules. So, have I done a mistake out of 2019? Absolutely not. The only thing I've done in here is applying my good old game to something I just didn't know, or at least doing it for the first time into time frames I wasn't nearly familiar with. And I needed this somehow little break I took at the end of this year to just distance myself from this and to have a clearer sight. So, apologize in here, absolutely necessary, because yes, I had to take a little bit of distance to see a little bit more clearly, because I was impacted. I mean, you just can't have a clear sight when you're too much into the problem. So the thing is in here, yes, I was obviously dealing with time frames I am not yet comfortable with, which means even though risk management is obviously working into every time frame, because that's the language of markets, and it certainly isn't going to change. At least I'm going to need way more proof before actually thinking that this is no longer the case. The thing is, the difference between longer time frames and shorter time frame is just time frame all by itself, which means remember that chaos is always going to be part of trading. When you put things into little boxes, that certainly doesn't mean that even if you have favorable cyclical condition, favorable momentum condition, and favorable trending or context favorable conditions, that certainly doesn't mean the market will obviously do what it is the most likely going to do. It's all about probabilities. And the thing is that no matter how hard I try to teach this to you, I know these rules because I applied them. I know these things because I've learned them the hard way years ago. Chaos is inevitably going to be there anyway. You're never going to be predicting, because out of a single trade, things can go out of control. Chaos is always surrounding, because anyway, markets will always be unpredictable. And if just simply make it rational, if there was no chaos, if you would be able to put things into little boxes, and the market will likely react positively most of the time, and we would be able to predict markets. And can we do this? No, we certainly can't. So chaos is in here, and I would say this year was just about proving chaos to whoever was stupid enough to think that they could control the market. But what I like about it is that this is the lesson I took years ago when it comes to shorter time frames. I mean, sometimes the market will just go on the opposite direction of risk management just to remember you that no fucking way you'll ever get to control things. All right? It's just like a hard way reset remembering of what the reality is in markets. You can not predict, but profit from most market moves because you just use the same old rules, which is just risk managing and doing the same old thing all over again in a boringly stupid manner. But still, you're always going to be surprised a little once in a while because things will just go freakingly out of control. And that's both fascinating and I know this thing. I mean, I've been coming across this so many times throughout the years. So it is even funny at some point to see people driving crazy out of this thing when it's just chaos and you just need to embrace it. So the thing is that I somehow forgot about this lesson this year, and the market just reminded it to me. But I needed to distance myself to just see it a little bit more clearly. So the thing is that these are time frames I never got familiar with. Like I can handle chaos for 5-minute candles without a problem. I even know how to recognize chaos at some point. But the thing is, in here it's been playing along monthly candles, which means you can somehow control your emotions and irrational behaviors that will come out of chaos, because chaos just does one thing to human being. It drives you fucking crazy. But yeah, I've been learning throughout the years how to easily handle 5 minutes chaos candles. I somehow forgot that this was just going as well on longer time frames. And it has been a problem, because it obviously has happened all along the year. We just had, like, if you take monthly candle, we just had 12 candles of chaos. Which means, that doesn't mean that it makes no sense or whatever. This is not about understanding. It's all about that what happened this year simply doesn't fit my boxes. What happened in here is not part of the things I can put into boxes when it comes to read markets. So what happens in here is chaotic to me, which means this is loss. It's inevitable. It's generally going to lead to loss. Chaos is what brings losses into risk management strategies. So was I inevitably going to be led to losses throughout the years, throughout this year? Yeah, I would say inevitably yes. Does that mean I'm going to change my game? Definitely no. It's just, first of all, acceptance is absolutely necessary, because the problem in here is that the natural biases you're going to get out of chaos are the ones we've been talking about into the psychological behaviors. The lessons I teach you, the lessons I've been taught years ago, that I just failed to apply in here because those time frames were too long for me. So long that I got myself involved into the scenario in a manner that I wasn't even able to see things clearly. And I just got myself into the good old stupid market behaviors, in which, lucky me, I didn't trigger trade out of this, but emotionally speaking, oh my goodness, it was freakingly painful all over the year. It's been a freaking painful year. But the problem is it shouldn't nearly have gone this way. I just I just made myself this way because I just got myself way too emotional with a single scenario. I mean, what the hell do I care about Wall Street? Actually, I don't really give a shit. It's just I shouldn't even have given a shit in any way. This is just a box that didn't work out this year. Now, I really need to recenter myself, especially into trading, because lucky me, like I said, I've been putting myself into a lot of pressure, and I shouldn't nearly have done that to me. And I wish I was more of a clear sight earlier than than waiting for the 31st of December, but still, I mean, better later than never. So the thing is, all right, I need to recenter, all right? That doesn't nearly mean I'm going to stop trading, all right? It's just we're dealing with long time frames that are obviously impacting all the shorter time frames. And I need to deal with that, which means for now, and I stand on this, I think that's probably the best decision I could have been taking over 2019, which is basically, yes, stopping the services to take a little bit of distance from these things, figure out the problems, and understanding that anyway right now, my only enemy, which has always been my worst enemy anyway, at least when it comes to trading. I mean, I teach you that everyone has pros and cons when it comes to trading, and you better want to use your pros and try to put your cons as far as possible from leading decision-making processes into trading. And my personal demon is simply impatience. When it comes to trading, I am a very impatient person, naturally speaking. And throughout the years, I've been learning to put impatience decision as far as possible from hitting any button when it goes to trading. I've been really successful at doing this throughout the years, but the problem is I somehow failed last year. And I got close to fail because emotionally speaking, I failed. I got myself way too emotional into a scenario. Lucky me, it didn't trigger a trading decision, which means I didn't sell the market out of the current timings I was able to do so. So in a broad picture of this thing, no matter how hard it was, emotionally speaking, I never, and not a single time throughout 2019, have triggered a trade out of irrational behaviors. So I can congratulate myself because of this, but the problem is I still have put myself into heavy emotional pressure, and I shouldn't nearly have done that. So it was about time to release that pressure. That's exactly what I'm doing right now, distanciating myself a bit from markets until I can put things into my boxes again. All right? And until I do, I'm simply not going to do any fucking thing, because the only thing I can do is just put myself into emotional pain. And I don't want to have to suffer this for no reason. All right? So it's as simple as that. Distanciating myself from markets until further notice, until I can put things into boxes again. So all I can tell is that right now markets are chaotic to me. Some people may try to give any sense to it, to explain why and what are the implications and whatever. And even I played this dangerous game in 2019, and I sincerely regret that. Spending way too much time talking about Trump's bullshit or whatever, the central banking going mad at supporting economies that are just giving their like last breaths and stuff like that. Right? These are just topics I should nearly have gone down to. It's important to talk about them because anyway, when we go trading medium to long-term scenarios, I've always been clear with that. When you go short-term, some things are going along with risk management. Risk management just apply into every time frame because that's the language. But when you go short-term, there are some inflows, outflows, market orders, demand and supply and stuff like that that are also impacting price behavior. When it goes to longer time frames, I always taught you that there are also things impacting in here. This is not just about risk management when you go long term. So I try to teach you a little bit of core basics of macroeconomical stuff and microeconomics and stuff like that, and also monetary policy, because these are the things that impact, just like supply demand and inflows outflows may impact shorter term price action. It's also that monetary policy and financial macroeconomical projections are also massively impacting long-term asset prices, just like risk management is. All right, it's like we sum up all those things to not explain, because it's not about explaining. It's just these are the most impactful market movers of prices into long-term scenarios. So I had to talk about them because they have been crazy fucking impactful throughout this year. So now let's try to get into a little bit more of technical review of 2019. And to me, this year has been obviously a big mess of those three aspects. So let's make it easy, all right? What are the most impactful stuff into price action, into long-term trades, and long-term trends, the one we're dealing with into those podcasts, are, just like we said, risk management, monetary policy, and macroeconomical or economical projections, the real economies and the perceptions we've got from it. So the numbers we get out of our economic calendars. So the first one, the one that we just talked about, macroeconomical projections, we basically haven't been moving for 2 years. So things are pretty much contrasted, but we're shaded gray areas in here. So we could go lower, we could deteriorate macroeconomical projections, we could improve them, or we could just range. So I think anyway, this is not what is going to be in a trending manner driving the market, because there is no trend anymore into macroeconomical projections. So it leaves us with two other candidates, monetary policy and risk management. So risk management is the one I know about. This is my job, and I haven't been failing. I'm sorry. This is not overconfidence. It's just I know my job, and I sincerely know what every risk manager has been doing over this year, and we've all done the same thing. We basically have done all this. We have all done the same things over the course of the latest 2 years. Every risk manager has been reduced risk taking. They've been buying some safer assets and selling riskier assets. And yeah, I'm sorry, but in that perspective, I haven't failed. I simply have done my job. The thing is that risk managing is not the only actor into longer terms. In here, there is a third player, which is monetary policy. And this one has been really fucking up the party this year, because obviously no one would have ever imagined what happened this year when we were just a year ago. No one would have imagined that the Fed will simply fuck up the entire repricing of market interest rates just to compensate from risk taking. I can understand why they have done that. I can really understand now why it was at some point, I wouldn't say predictable, but very likely. Though monetary policy has been reversing into a way that I don't nearly think is going to be more than enough to sustain the actual risk-taking, because it's all about it, all right? Markets are trying to forecast the economy. So we're trying to project the economy's stance and shape and strength into future. So we try to bring in profits to spread out money, and we try to compensate risk-taking. But it's all about risk-taking in any way. So when prices go up, we bring up the risk as well. The risk of eventually being wrong into the projection that the markets are doing. Obviously, when we go too far into projections, this is where we create financial crisis. When we go too far from reality, then generally we take a big slap right in the face, bringing us back to reality, financial crisis. And history has been tending to say that generally, once a decade, we tend to take a little bit too much risk and create those distortions between financial forecast and real economy, and we are into those times of a decade in which I don't want to follow the paradigms. So it was about to figure out whatever the paradigm is for this economic cycle starting from 2009, and basically since then the paradigm has been, when we're lacking of investment, we can force investors in by improving the market liquidity, which means printing money. And by printing money, what we do is that we force inflation, and inflation forces investment. So that's what we've discovered throughout this economic cycle. That's what's been forcing, I would say, investors have been traumatized by 2008. They basically discovered that money can disappear. And they simply discovered, all right, you know what? They lost confidence. So obviously, we discovered a tool that was bringing back confidence. It worked just fine. and poured money back in the market and poured confidence back in the market as well. But the problem is, obviously, as now risks are piling up because, just like I said, the economy wasn't really performing crazy fucking well back in those days, but we needed to have investment anyway. So markets have been anticipating the future the future well-being of economy. So it's already in prices right now. So going higher would mean that the economy will accelerate. The question is, maybe we are wrong. Maybe we have gone too far. And if we have gone too far, another economical crisis is likely down the corner. What shape is it going to take is freakingly hard to say. But I stand on this right now in terms of risk management. The markets are still neutral to neutral bearish, but certainly not bullish. So why the hell are we having historical tops closing 30% gains in 2019? How is that possible that risk management was so wrong about what prices have actually been doing? Yes, obviously, part of the explanation is monetary policy. That's the first shift of 2019. It's been occurring and starting right in here. So I'm going to use my usual arrows, is much better, right? So this is the first switch of 2019, the first time central bankers changed the words that we're using into the FOMC meeting. That's the first time we learned that they were thinking about changing policy and not just stopping interest rates like they were doing previously. They basically stopped rising interest rate. But in here's the first time we clearly had glimpse that the market, that the FOMC was likely going to cut rates, which is not just stopping rising, but going the opposite direction, like a 100-degree reversal out of the previous the previous policy stance. So it was a huge change. And obviously, I can understand that this has changed the course of this year. But yes, that explains this and this. And that certainly doesn't explain, no, I would say that explains this and this. Though we go to the next bearish signal of this year. All right, remember that in any way, in a technical perspective, we terminated 2019 very low. We broke and holded candle closes below monthly supportive area, which means that's not nothing. Yes, we might have gone a little bit too much bearish at the end of this year. It was a little bit too much. I even bought those lows at some points for just retracement. So first, trending signal. So in here, is there bearish trend in the market? There was signal for trend. So I had to try out this signal. The thing is that obviously market behavior in here got altered by monetary policy. In here there was risks of a bearish trend. Remember that gains is risk taking in market. And in here what happened is basically central bankers saying, all right, we're going to take part of the risk so you can take the gain. It was pretty hard because that's the game they have been playing throughout 2012 to 2015. It's a game that has been working, but that we know is working less through time. So we're trying to play the same old cards, knowing that anyway, no matter how, the effects will be dampening through time. As we play those cards, they will be less likely to produce the expected effects, but they will increase both the indebtedness, the central bankers' balance sheet, and obviously the monetary aggregates. So we know there are real monetary consequences for this, but we're not certain that we're going to get the economical consequences that we're seeking for. We know that their effects are dampening. So anyway, going in here was the next step. After the central bankers switching monetary policy, markets were about to readjust, and that was absolutely normal. Until this moment, everything was just not necessarily predictable, but I think that was understandable in some way. So something added, because in here something had to push us to new historical highs. And in here it was a totally different actor. Certainly not the monetary policy, Monetary policy was just erasing the risk of a bearish trend. It wasn't nearly creating bullishness. Remember that what central bankers have been doing is just taking part of the risk to avoid too much bearishness and panic among investors, which is obviously exactly what they had to do, because their job is financial stability, and they could certainly not let investors drive themselves crazy. So they tried to prevent crazy behaviors, but this had consequences. The problem is the message has been learned. Like, the actual lesson is that speculators have been proven wrong, because we were pricing in the risk and the central banker decided to take part of that risk, which has been shifting reality from prices, because part of the risk was taken by the central bankers. But they just done what they had to do, preventing panic sellings. It worked just fine. The problem is it had and it created consequences. The consequence, sorry, just wrong button. The consequence is this one, is that we have been adding some very dangerous speculative positions on volatility, which means the danger right here, right now, is not necessarily what the central bankers are doing. I tend to believe that this is just the tip of the iceberg. This is the thing that people tend to talk about, and myself, I've gone down these huge problems of talking way too much about both the monetary policy and stuff like that, and talking about Trump afterwards, because Trump has been a major impactful stuff. We're going to get through this later at the second stages. But we've been talking too much about those things. I think the real problem we're actually facing, the real problem of 2019 is volatility speculation and derivative pricing. I think this is where the problem is, and this is where the risk still is hidden for 2020. I'm not saying that we're not going to flush out this risk. All I can tell is that the central bankers are now down the corner. They have not enough room for more risk taking, but the risk is still there. So we better hope it doesn't show up. I never said it will. All I'm saying is that if it shows up, there will be no safety net anymore, because no one can save the market now. Central bankers have been doing what they had to do. They've been playing their cards. Now the market is rising, and the risk is rising accordingly. You better hope the risk is not going to show up, because if it does, no safety net this time, which means volatility and market refitting with reality, which means, remember that it's all about reality, actually. People are now dreaming and forecasting and stuff like that. We should be just waiting for information, because let's be freakingly honest. There is a freaking third party into this game that everyone is now forgetting about. It's economy. What is doing the economy? We still don't know, because the economy is giving us mixed signals. We could be bullish, we could be... No, it's not about bullish and bearish. It's more about where are we going to go 1 year or 2 years from now. No one is able to tell right now. No one. Because we have projections that suggest we might be overheating, meaning that probably worse conditions are to be expected. But we also have some people thinking that worsening the conditions might have to obviously create a financial crisis and stuff like that, and a recession. And it all suggests this is also less likely going to happen. So I think what we're living right now is just this mixed feeling in which we're trying to play the old games of 10 years of growth means we have to get 2 years of recession. I don't think that game is at play. I think what is at play is that we need to price in risks, and we need to do it well, because if we don't, we're going to create a financial crisis. I don't think that financial crisis will eventually bring down economy as well, but I think economy right now still remains pretty weak. So instead of stupidly pricing in risks, hoping that everything will be fine, we should just be breathing a bit and accepting that market pricings may need to be standing still for a little while. So instead of bracing for more gains into stock market, we should just embrace fucking range. And that's exactly not what we've done in 2019. So either I'm wrong or 2019 is wrong. And that's the big challenge coming from 2020, and we're going to study market structures and stuff like that. But that was necessary to say. I think the big problem right here, right now, is about volatility, because we can't nearly get closer to what we've done. This is absolutely not normal with the actual macro projections we're having right now and signals we're having from the economy. This is not normal. Not the fact that we're there, though we should nearly be there anyway. But even if you take and if you account the fact that part of the risk has been taken by the central bank, certainly not the risk, the problem is volatility. We should nearly have something like that. When you have a burst of volatility coming to 30 and 40 area, you simply don't crush down volatility afterwards. Though in here, we should have had risk management, meaning that the bears should have pushed price towards supportive area, we should have ranged a bit before eventually even going higher. So what I tend to say is that the problem of this year is not the fact that we ended up in here, is how we have gone up here. And there is three phases. So the first one, the risk has been taken by the central bank, and I can definitely understand that. Problem is in here. Started there. All this phase is Trump getting control over market. Obviously, it happened exactly the way I would think it would, volatile and stupid. So Trump tried to take control, giving bad news in here, trying to support price with the deal, dealing bad news from economy and Trump trying to support the deal, whatever. It's just been trying to play and gamble with the markets in a pretty stupid manner. And I still tend to believe that there will be some trials in the future for collusions and stuff like that throughout its administration, because, that's really a dumb manner of trying to go inside trading. But anyway, that's the future. So first part is obviously monetary switching to taking part of the risk. Then we're trying to digest, but instead of digesting to the downside, Trump is obviously trying to take credit for it. The stupid thing that Trump, basically doing Trump, is stupid and he's just bringing what people ask him to do, which means he doesn't know shit about what to do, he's just talking and assessing what people cares about. So when he started yelling about the strong economy and the strong stock market, he saw people liking it. So what he's been doing, exactly feeding what people want. Trump is an asshole, but he has one real good thing that I can't avoid to tell about him. This guy is good at doing what people want him to do, which means he basically saw an opportunity and he's just been bracing for it since then. He's seen that people want him to make stock market higher and he's just working out this way. So he's doing anything he can to bring stock market higher, even if that means stupid manipulating information and stuff like that, and this will have side consequences. It's just a matter of time, because this is simply piling up risks, and you better hope that the risks don't show up. But who knows? It's not because Trump has been bullshitting that the market will inevitably have to go down. Simply means that if the market goes down, we're gonna have to pay for this bullshit. So it's just that we priced in things that better had to be right. So it's all about economy right now, and 2020 is all about that. We still have mixed feelings coming from the economy, but we priced in the best. So it has to be good right now, because if it isn't, we'll likely go in the opposite direction. Does that mean we're going to crash down and fuck up market pricings? That only happens if we go for the worst case scenario, in which we truly go for recession and economy really is deteriorating. But it's a three-way scenario. But it's a three-way in which we only have one choice right now. At the current given time, with the current valuation, out of three options, we're only pricing in one, which means we've got 2 out of 3 chances to be wrong. That's the reason why, in terms of risk management, buying right now is not even an option. That doesn't mean selling is the only option as well, because you still have 1/3 of a chance to be wrong. And if you're wrong, and if the market keeps on rising out of that much risk-taking, it's going to rise parabolic. So there is a risk for a bubble. That was the risk of 2019, the risk I started yelling about all year long. We can create a bubble out of current market pricing. It is risky, and if you sell a bubble, you're gonna be fucking broken. And this is nothing like teaching risk management to people. So right now, the risk I was fearing about all 2019 long is inevitably in front of me. We can have a bubble out of what happens right now. The bubble's already there. We have a bubble on Apple. We have a bubble on Microsoft. All those assets are pure bubbles. There's not even a chance you can tell them any different. We are right into bubble trading right now. The thing is that Apple and Microsoft and Boeings and stuff like that, they are not everything, right? The SPX is 95% of US equities, it's certainly not just about those few guys who are going crazy fucking bubblish parabolic. But as long as these guys are going parabolic, we're not going to have risk management, because those things are weighting so much into indices that they're getting problematic. They're altering risk management all by themselves. Because what's funny in here is that over 2019, if you take the SPX and if you reduce out of its own weighting, like Apple itself is weighting approximately 6% of the SPX, take it Microsoft and the other top 5, it's basically the top 5 is pricing from 15 to 20% of the SPX. And this also, by the way, is what explains the final stages of 2019. This was range, all right? This was somehow hesitation, digesting, and stuff like that. This part is just because of those big guys. These overweighted assets into the SPX going fully parabolic, and basically this is where we switched bubble. So this is, I can understand all of this, even though this has been a little bit too much bullish for me. So this was the moment where I started feeling that something wasn't going right, that instead of going back to risk management, which is the market standards, we started going from, hey, we might be trying a little bit of dream, that isn't that bad afterwards. And yeah, that was favorable conditions to set a bubble. And now we're right into it. And the question is, how and when is it going to stop? Because the bubble is there, whether you like it or not. There is no other words to describe some of market components right now. So the SPX isn't a bubble at the moment, but most of its, some of its components, those who are heavy weighting the SPX, almost 20% of this cap, are going crazy fucking bubbles. And the risk is that this thing has only subjective limitations. Who can limit a bubble? I mean, Apple is now 300. It simply isn't any rational, but I mean, we can go 400. We can go 500. Who gives a fucking shit? It's not about pricing the asset anymore. I mean, just take Apple. I mean, instead of talking, let's just bring a chart. I mean, just, oh man, how can you even try to make this thing rational? I mean, just volatility aside, I mean, just look at that. That's a freaking fucking bubble, and every risk manager knows about it. So there's not even a chance we can put any other word than just, oh man, this is freakingly dangerous. Just have a look at the real benefits. I mean, just few years from now, we're just 15% lower. We just doubled the valuations until then. So that's just freakingly stupid. But anyway, that's not the point. We're not trying to make any sense out of this. This is not the point of bubble. The point of bubble is just going freaking crazy chaotic and going as far as we can before fucking it up. So can we go even more fuck up in terms of Apple, Microsoft and stuff like that? Yes, we can. And regarding the fact that they're weighting 20% of the SPX, how the hell do you want to trade the SPX? That simply means that you can risk manage part of the SPX, but 20 to 25% of it will just fuck up your risk management opportunities. So that's the reason why I'm not trading those assets anymore, at least not until we figured out to go back to risk management. Will we go back to risk management? Obviously fucking yes, because there is no other choice. The further we go, the more dangerously we're heading toward a financial crisis, and the more impactful the financial crisis will be. So I sincerely don't think that we're going to go down this way, simply because I don't know, so I could be wrong. But anyway, I don't want to risk my capital into this game anymore. I'm not selling stocks anymore. At least not the stocks that are real dangerous. Some of them are just working fine at the moment. And if they end up being proven wrong and going bubble as well, I just let them go. The thing is, right now the only choice you have is whether you want to follow bubbles or play risk management. If you would like to say, all right, I think Phil is wrong and it's about time to play bubbles, play this game. Play it. I mean, like I said, I'm not here to tell you what you should do or shouldn't do. I'm here to teach you risk management. All I can tell you is that we're no longer risk managing in Wall Street. I think we're going on the edge of trying to create bubbles that I don't even think will be putting in place. I think that's just a stupid way of ending an economic cycle, trying to prove wrong for the bears because it was too much predictable at some point. But I think we're going to go there anyway. We're just going to fuck up timings at some point. Like too much people thinking the crisis was down the corner last year. We just fucked them up for a bit and then we go for it. That's exactly what I think we're doing. So in the meantime, things are going irrational. Applying risk management is certainly not things you can do in here. So I'm waiting for signs that markets participants who are risk managing the way I do will go back in the game. Because for now, I don't see them trading. The only people I see trading are short-term traders, guys who are just buying at the morning, selling halfway through the day, and just getting the fuck out, and not even thinking about the broader picture. But whoever's caring about the broader picture right now is not even trading, or they're not risk manager. They're guys who are playing with credits or playing with someone else's money, and they're just blindly following stupid trends, which are most likely bubbles more than anything else. So yeah, it's like, remember what I told you earlier, it's like going to England and learning English to get to communicate with people. Like right now, it feels like I've been going to be taught English, but I'm basically ending in Spain trying to talk English with guys speaking Spanish. So I'm just not in the right place. And the thing is that there's no other choice in here but to just stand the fuck by. I can keep on yelling English to people speaking Spanish. It's not going to change anything. I'm still unable to communicate with market at a current given time. I'm just waiting for signals. That's some English people showing up again in here. That's just an image, obviously, but I bet you understand it more clearly this way. All right, so it's not a crash down of psychological madness on my way. It's just I'm rationally unable to act at the moment, so I'm just patiently letting it go because there's no other choices, taking a little bit of distance, and waiting for things to go back to my favorable conditions. Until then, obviously indicators are free, so they're probably going to be free as well for you for the whole January, and it will be extended as long as necessary. Obviously, I'll be the first one to be happy to restore things to their usual way, but I just can't give any dates simply because we're dealing with monthly breakouts at the moment. I just take the SPX. You take it monthly. As you can see, we do have a monthly target in here. It can last for another 48 months. So it can take just a few weeks, just a few months, or it can take up to November 21 until we actually get to be able to deal with this market. So a lot of things can happen in the meantime. I still tend to believe that the current global overall context is a range, which means until we get clear sight of macroeconomic projections, there's nothing we can do with those markets but risk managing. Risk managing is not nearly the key and the motive right now. It's more about sentiment and stuff like that, which totally confirms what I think. We're not nearly trending, but we're still ranging. We're just ranging out of time frames I would never ever imagined to be possible to range out of. So I think we're just ugly ranging. So I'm still playing the exact game of 2019. I'm still playing the same old game of a year ago. It's just this year was about fucking up risk management on shorter time frames, shrinking volatility out of very dangerous bets on the future, and better hope that every signal we get from the economy for the next 2 to 3 quarters are going to be just positive. Otherwise, if they keep on being mixed, and I better damn think that they will be, we're going to have to dampen some valuation, which means we better hope that those bubbles gets fed up as much as possible and they will sustain price as long as possible, because when they'll start collapsing, it's not going to be pretty. And we're going to have volatility. And I just hope that when we get volatility from those bubbles bursting, we better have to have good signals from the economy. I still believe personally that we will. But the thing is that at that time, the motive would change, because we are going to have bubble bursting with positive signals from the economy. And I don't think it's going to be bullish for prices. I think it's going to be neutral, ranging. So beware of potential bearish movement throughout this year if such things show up. And for this, bubbles will have to burst. But that doesn't mean you have to go crazy bearish as well, because we might have mixed or even positive signals coming from the economy. And remember that if I have to give my feelings for these 20 years to come, it's going to be messy. It's going to be all about sentiment. It's all about range. So you better like to bring out your Bollinger Bands, play with standard deviations. Be careful, because obviously all the midterm ranges that are going to set themselves in the meantime will likely be fucked up as well, just like we fucked them up to the upside. So I think volatility is the key element of 2020 if we get to trigger the bubbles. As long as we don't, beware of the risk for the bubble to spread out to multiple factors, because the big names might be holding well at the moment and not going too much bursting bubble, but if they burst, that doesn't mean the other assets that have been sold for 2 years will not be interesting to buy. Just like those General Electrics and stuff like that, some assets have been oversold and they can be interesting to buy. So don't forget that right now, the stock market itself, in a broad-based S&P way of looking at things, there are some bullish opportunities to make if prices just dampen a bit. There are also some heavy overweighted bullish asset in it. So the only leading possibility in here, the only thing I would bet on, is that we've been somehow managing to get very low volatility all throughout 2019, and it would never have been imaginable back in those days, but it happened. I doubt this will last for 2020. That's the only thing I would say. So until I get proof that the volatility is showing up and that risk managers are taking control of market pricings back again, I'm just standing still, standing back, having a look at market, but not necessarily on an hourly basis like I would do normally. Most likely having a look twice a day, no more than that, because looking at anything more than that is just not making sense anyway. So until I get something I can put into my personal boxes, I'm just gonna distance myself from this shit and waiting for things to go back into favorable conditions in which I can work. That's as simple as that. That being said, and until further notice, though, the service remains free. I'm talking about the indicators, which means I'm not making the daily updates. And I'll keep on not doing it as long as it will be necessary, simply because I don't want to bullshit, and there's nothing I can tell about risk management because, like I said, until further notice, risk management simply doesn't work. But it will obviously work again. It's just a matter of patience, but we're talking about possibly monthly like patience, and no matter how long I tried to keep this thing going on, it's been going on for too long, and so long that I myself have reached my own personal limits, and I just can't take that same old speech on a day-to-day basis when it requires possibly another couple months or even a couple quarters of waiting for these things to dampen and find a market top. All right? Before I get to confirm my range scenario, I need to see a market top building itself. And for now, I just can't say that for sure. So I'm waiting for this to show me the direction. Either we go higher to find a higher boundary, or we start going lower and we validate a boundary. But until then, there's nothing you can do. All right? So when it comes to forex, things have been interesting. and we have some signals coming from the dollar. So it's really starting to rise, a lot of interest coming from monetary markets. So it's really ringing some bells, showing that volatility might be showing up in the near future into stocks, but I'd rather like to wait for actual clues, for actual actions rather than just clues. So rather than talking too early, I'd like to wait for things to be actually there. I'm obviously having a look at those markets every day. All right, no problem with that. But just most of what I see just makes no sense. So until I get to make any sense of what happens, not to understand, just put it into my boxes. As long as I just can't put it into boxes, just need to wait. All right. Same goes for the financial markets. Over 2020, I strongly invite you to have a freakingly interesting look at the yen, because I think the yen is going to be a very volatile asset throughout this year, but not necessarily the way you understand it, which means the yen might be first a very attractive currency because of its interest rates and stuff like that, but it might rapidly be a huge problem for the financial system because it's also the bad little brother who's basically 300% in debt of its GDP, who's been printing money for 20 years, who is under heavy pressures of deflationary actions. So beware of this. All I'm saying is that yen might be volatile. That's the only advice I'm going to give you. It's something I already gave you, but I'm just going to say it again. If you are trading any pair that is yen included, you need to put profit taking on all those trades. It's absolutely necessary, because if you take just the USD JPY and how it's been trading in early 2019, like these kinds of things should really ring a lot of bells. Because if we are about to get there, this can be just done the same way, which means just 1 or 2 days of collapsing USD JPY, real short term. But if you don't put your profit taking in those areas, you're likely not going to be profit taking at all, because it might be just go in there for a few hours and of the story, and then we'll reverse very rapidly. So be aware that volatility might be very brutal in terms of currency markets throughout 2020, and that I think most of the swings that will happen in 2020 might be just happening for a few hours or a few days. But still, these are the trades we're going to have to catch up. So be real cautious with the currency markets. I'm going to terminate because obviously people would just yell at me if I wasn't talking about cryptocurrencies. So let's take another 15 minutes talking about them. What is my vision for 2020 on those things? I mean, first of all, I don't know. All I can tell is that I'm still updating on a weekly basis into TradingView to give you my both personal feelings and technical assessment in here. I still am pretty curious about whatever happens in the nearby area with cryptocurrencies. I clearly see two visions of the world fighting themselves. One that is financial crisis is never going to happen. We're going to fuck up all those we're going to fuck up all those ugly anarchists, and we're going to teach them how to rule. So that's one way, one very bold way of seeing things. All right, typically the kind of bold things that can create ugly financial crisis. Probably those guys have been selling the VIX all year long. And I see on the opposite direction a lot of angst and anxiety from people not really following those guidelines and thinking that they shouldn't be listening to this bullshit. So I see those guys buying those cryptocurrencies and stuff like that. I see obviously some risk managers like me who are getting in at interesting prices and who are risk managing in the meantime, just preparing for every possible scenario. So I would stick to what my job is, which is not nearly forecasting what the shit is going to happen, because I don't know whoever's going to win that stupid battle out of those who are selling the VIX because no matter what, we're going to crush down those bastards. And the others who are just fighting those other bastards and saying, you fucked up the financial systems, we're going to cut some throats and create a better financial system. I tend to believe that any fucking way we need to be ready for both cases, and the likely outcome is going to be something in between those two. So I would tend to say both sides will probably be wrong with this game. So that's my personal feeling. That doesn't mean that this is what's going to happen. Though in a technical manner, I'm just doing my freaking old game, risk managing. So my risk management is there is two options for this year. We can likely price in this blue area for quite a long time. This is where we're likely going to find some support. The first area is just we dip a toe in here and we find some huge supports, and the next up is obviously the red area in here, which is 16 to 18K. And the big mistake in that perspective will be not to profit take, because let's just picture it. I'm just going to use candles projection because that makes things a lot more understandable for you. So let's just use freaking candle projections. Where the fuck are they? Oh, there it is. So let's just bring previous prices movement. Let's just take just the parabolic skimming shit. All right, so remember that things always replicate, but with different amplitudes and time scales. All right, so let's just assume something like that shows up. Like, all right, I'm going fast, I'm going crazy. Let's just assume we're here. All right, what do you think people will think about it? They'll say, oh my freaking good damn it. They'll start zooming out and they'll say, all right, we're here, so projections are 15, 50K, 56, 60K, whatever shit that is. We're just going to be in an ugly fucking range, which means if you forget about profit taking in this area, huge problems are down the corner. Because in terms of risk management, and once again, I'm not saying that the revolutionary things that people might be wanting for bitcoins and stuff like that will not happen. I don't know. All I can tell you is that my job is not to know. My job is to fucking risk manage. So my only question is, how much of those cryptocurrencies do I want to have at each given time? If we go to this area, I likely will reduce how much of those things I have. Will I sell them all? Certainly fucking not. It's just how I'll do things. But in a risk management perspective, if we go there, this is the only thing to do. Profit take. That doesn't mean short selling. That doesn't mean any of this. That simply means in here, a target will be filled, and whoever will be stupid enough to buy in here will play anything that is but risk management. These guys might likely be forecasting that the entire civilization will collapse, that the fiat currencies will disappear, and the choice that follows up is either they're right or they're wrong. If they're right, that's fine, but still, they would have made much better investments by buying the much better prices we have right now, instead of buying market tops, or possible market tops. Because if they end up being proven wrong, they're going to lose shit ton of money. All right? So learn your lessons the hard way. As long as we reverse out of those areas, the most likely scenario is to reach out to these areas. We're likely going to be doing it freakingly stupid rapidly, but not necessarily. All right? But this is where we're going to target. How long is it going to take? I don't know. It can be this. It can be taking way, way longer than you imagine. Remember that this is absolutely unpredictable. We can do this. Like, we're here, you think that you're going to be there 2 weeks afterwards, and no, we spend another quarter in here, another year, and who fucking knows? All I can tell you is that the only area I care about as a risk management area, as we will eventually reverse in here, and as long as we are dealing with those prices and not lower ones, as long as we stick with reversing in this fucking blue area, I'm just targeting this red one. I'm not targeting anything further than that, but just playing a bubble, and playing a bubble, let's be honest, I'll play that with 10%, 20% of my initial investment at best, but I likely will sell more than half of my coins in this area. I'm still going to keep some, but not all of them. You can apply this same game to gold. Gold is soon to reach out my targets. The targets I've been putting in motion almost 2 years from now, all right? And now we're going to reach out to those targets. All of those red lines, I'm going to monitor price action in all of them to profit take. Just byte by byte, I'm going to reduce my exposition to gold because these are the fucking targets I have. And I'm not going to change my plan because whatever that is, I had a plan, I'll follow this. Simple as that. I have both physical gold and paper gold. I obviously will sell paper gold first and eventually even try some reversals, which means I eventually will start searching for selling paper gold. It will be obviously speculative with stop loss and stuff like that because there is a risk to create an ugly bubble in here if, even though I don't think that's the most likely scenario, but if we go creating a freaking bubble in here, these things can go really out of control. All right, so how do you play bubbles? You never know when a bubble will set itself. It happens and it's unpredictable. Who would have imagined that Apple will go that crazy? No one. So those who are into this boat, congratulations, you're in a bubble. You're going to make the headlines. You're going to be the smart guy who bought the freakingly buzzy assets in which everyone will talk about. I mean, you'll never hear more about Apple than the year to come because Apple is going to be into every fucking investor's mouth like, where is it going to go? Where is it going to go? How high can we go? How this thing will collapse the day following? It's just as stupidly freakingly crazy as it can be. So don't think bubbles, and that's going to be my final words. Don't think that bubbles are the way to make money into trading. They're simply the way that most people get to talk about trading because that's what's interesting, that's what's emotional, that's what makes a shit ton of money. This is where you make the 20 times the initial investment, the 40 times, the whatever that is. The reality, and let me tell you something, I know a lot more than you think about the financial reality of people. They are what people say, and they are what really happens. I know just really few people who actually managed to make those big calls onto one asset and hasn't been messing around for the rest of their lives. When you make a speculative bet just like that, you get on a financial bubble and for some reasons you manage not to collapse psychologically, which means you still remember to profit taking there. Those guys who are smart enough to forget about dreaming when the dream really comes really too fucking crazy, then first of all, congratulations, but be aware that lightning is less likely going to strike 2 times in the same place. When things happen once, you will obviously want to replicate this thing for your entire trading life. But that's not what trading is about. Trading is a boring, day after day, repeating the same old fucking stuff, because that's what risk management is. Bubbles are part of trading just like speculative risk management is. It's not one being on top of the other. They are always piling on top of each other, right? Just like monetary policy will impact as well, right? So market can go crazy fucking stupid like they are right now. This thing can last way longer than you would imagine. So if you're selling thinking that anyway this thing will have to collapse, they can collapse 2 quarters from now and they can triple value in the meantime and also fucking up your account as well. So the only way to do this thing is either you think you're lucky and you're going to catch up on the bubble and it's not going to burst tomorrow. Good luck on that. I wish you financial success, and I certainly most likely hope that you'll be able to get the fuck out of this before it bursts. Or you can just do risk management, understand that the current given times are not really about being rationals and stuff like that when it comes to apples and stuff like that, but that the broader picture, the larger picture, is still totally about risk management right now. I think the SPX, even though it's partially being stupid, is still pretty much a big fucking range. And if you just put out the 20% of stupid assets waiting in the SPX, you'll see that range a lot more clearly. I'll eventually try to work out these charts in the next following days. I don't know exactly how to do it. Needs a little bit of calculation to properly weight all of these assets. But basically, if you want to look at the real US economical perception, you just put out those top 10 assets that are heavy weighted bubbles and stuff like that. If you put them out of the SPX, you'll likely see something that is way more matching this this market context I'm talking to you about, which is, and I stand on this, to me, still a fucking ugly range that we're likely not going to get out of until probably next year or the late stages of this year. So until we actually get to join again economy and asset prices, I think there is still a lot more things to come. All right, so it's going to be an interesting year. It can be stupid and volatile a little bit at the early stages of 2020, but I doubt it's going to last very long. That's my feeling for 2020, and obviously I'll keep you guys updated as long as things stand to deliver interesting informations. So far we have none. I mean, this is just like I said, it's still stupid, and even what happens today is still feeling a lot stupid to me. Like, people tend to say, oh my god, we've got a war, so it is about time to act immediately. I mean, what the fuck is that? As you can see, Wall Street is not nearly caring about it as we speak. So yeah, I don't nearly care. I think this is just short-term stupid game that we still have at play. So wait for more reliable information. When I'll have those information, I'll be the first one to communicate and spread out the word. So yeah, until then, don't go stupid crazy. Don't follow those ugly market movements. It's, I think, just stand the fuck by. I know it's painful to wait, but this is really the only rational thing to do right now for a risk manager playing on those time frames. All right, rushing things and trying to think that you can have any impact on markets is just as silly as it could be. All right, so stand the fuck down, be rational again. Don't let irrational emotions drive your actions. The best thing to do right now is not to act. Bye, guys.